Every time you swipe a credit card, take a loan, or even pay taxes, someone, somewhere, makes money. Not from your purchase, but from the debt itself. What if I told you that the global economy isn't built on wealth, but on debt, and that the more you owe, the more powerful certain institutions become? This isn't a conspiracy theory. It's a design, a system that rewards borrowing, punishes saving, and quietly transfers power to the few who control credit creation. This is the story of how the modern financial system learned to profit every time you borrow, and why escaping it might be harder than you think. Origins. The birth of debt. As money. To understand the system, we have to go back to the early 20th century, before money became what it is today. Back then, money was tied to gold. Every dollar represented a claim on something real. Banks could lend money, but they couldn't create it out of thin air. Their power was limited by physical gold reserves. That changed in 1913 when the Federal Reserve was created in the United States. The idea was simple: stabilize the economy, prevent panics, and ensure a steady money supply. But hidden in that design was something revolutionary and dangerous. For the first time, money could be created as debt. When banks issued loans, they didn't lend existing money, they created new money. Out of nothing, it was a quiet shift that transformed the global financial system forever. Money was no longer backed by gold, but by the promise to repay. Rise, debt as the engine of growth. Fast forward to the post-World War II era. The world needed to rebuild. Nations borrowed, companies borrowed, citizens borrowed. Debt became a tool for progress. The 1944 Bretton Woods Agreement established the US dollar as the world's reserve currency, backed by gold at first. The US could print dollars, and other countries held those dollars as reserves. But there was a problem. As the US printed more money to fund wars, welfare, and expansion, there wasn't enough gold to back it all. In 1971, President Richard Nixon made a fateful decision. He ended the gold standard. The dollar was no longer redeemable for gold. From that moment, money became pure trust, or rather, pure debt, and the system thrived on it. Governments discovered they could spend without saving. Central banks could lower interest rates to encourage borrowing. Consumers were told to buy now, pay later. Every loan created new money, and every repayment destroyed it. The economy became a self-feeding cycle of debt creation. Growth depended not on production, but on borrowing. The breaking point. When debt outgrew reality by the 1980s, the system had matured and metastasized. Wall Street had discovered a new form of magic. Financial engineering, mortgages, credit cards, student loans, all bundled into tradable securities. Debt became a product to be bought and sold. Banks realized something powerful. The more they lent, the more they earned. Each loan generated interest, a steady stream of profit. The incentives were clear: create as much debt as possible. Governments followed suit. Politicians learned that voters loved spending but hated taxes, so they borrowed instead, passing the cost to the future. By the time of the 2008 financial crisis, global debt had exploded beyond comprehension. When the system finally cracked under its own weight, governments rushed to save it, not by reforming it, but by doubling down. Central banks cut interest rates to zero. They printed trillions in new money through quantitative easing, buying bonds and assets to stabilize markets. In theory, this was supposed to help everyone. In practice, it made asset owners richer, governments more indebted, and banks even more powerful. Fallout. The illusion of stability. After 2008, the world entered a strange new phase, an age of permanent debt dependency. Debt became so massive that the system could no longer function without it. If people stopped borrowing, the economy would collapse. Governments discovered they could no longer afford higher interest rates because servicing their own debt would become impossible. So the game continued. Low rates, more borrowing, more stimulus. Each crisis was solved with more of the same poison. And the result? Global debt today exceeds $315 trillion, more than 3 times global GDP. Here's the shocking part. Every dollar of that debt earns interest for someone. That means as long as you owe, whether it's your mortgage, student loan, or credit card, the system continues to profit. And who benefits most? The institutions closest to the money printer, central banks, commercial banks, and the investors who receive the new money first, before it loses value. This is known as the Cantillon effect, the hidden advantage of proximity to money creation. The rich Danti just earn more. They get new money before the rest of us do. Failed fixes and repeating patterns each time the cycle threatens to collapse. The same solutions appear, print more money, lower rates, create new forms of credit, but those fixes are illusions. Low interest rates punish savers and encourage reckless borrowing. Inflation erodes purchasing power. And when debt becomes too large to repay, governments quietly inflate it away, effectively taxing everyone who holds cash. Meanwhile, central banks insist this is stability. But history tells another story. From the Roman Empire's coin debasement to Weimar Germany, SC hyperinflation, every civilization that replaced real value with printed promises faced the same end. Debt expansion works until it doesn't. And the longer it lasts, the more catastrophic the reset becomes. Modern parallels, the new digital debt machine now. We're entering a new chapter 1 that makes the system even more powerful. Digital currencies, instant credit systems, and AI-driven finance make debt faster, frictionless, and invisible. With central bank digital currencies, CBDCs, on the horizon, the line between money and surveillance blurs. Governments could, in theory, control how money is spent when it expires, and who can access it, locking entire economies into programmable debt cycles. And here's the twist. The next era of debt might not just be financial. It could be data-based, where your digital footprint, spending habits, and even social behavior become part of your financial score. The machine that profits every time you borrow may soon profit from everything you do. 3 takeaways: a warning and a call to action. Takeaway 1: debt isn't just a tool, it's the foundation of the modern economy. Understanding how it is created is the first step toward seeing the system for what it truly is. Takeaway to the players who profit from debt: banks, governments, and investors have no incentive to stop. Their survival depends on keeping the cycle alive. Takeaway 3: real independence begins when you step outside the system by reducing debt, owning tangible assets, and understanding how money creation really works. Warning: every debt-based system in history has faced a reckoning. Whether it's a currency reset, inflation spiral, or total collapse, the pattern always ends the same way. Trust evaporates. The only question is when. Call to action: if you found this story eye-opening, share it, because the more people understand how this system works, the less power it has over them. The system profits every time you borrow, but knowledge is the one thing it can't monetize.